Hello and welcome to the Logistics Management Podcast. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, I'd like to welcome Dean Croke to our podcast. Dean serves as DAT Freight and Analytics Principal Industry Analyst. Dean has more than 35 years in commercial transportation, data science, and risk management. What's more, he's also a CDL holder, and he's actually been with DAT going back to 2020. Dean is one of the industry's leading voices and shares market updates weekly at DAT.com and also on DAT's YouTube channel. Dude, Dean, welcome to our podcast.
Great to be with you, Jeff. Thanks for having me.
Absolutely. So, Dean, you're coming on here at a good time. There is so much going on, especially when we look at over the road market activity.
Hmm.
So, why don't we just sort of start at the top and let's just look at the truckload markets, Dean? What's happening here? We
Yep.
could probably spend our whole our whole allotted time on this subject alone, but why don't we kick off with that?
Yeah, we could. From a carrier's perspective, these are certainly very good times after 2 to 3 years of fairly, bleak performance. But
Hmm.
the snapshot, if I had to give you sort of a 1 minute summary, I'd say it's still a supply-led market. Truckload pricing is firming faster than freight demand. And this structural capacity loss that we're seeing is really doing the heavy lifting rather than any broad-based demand. So,
Right.
and on that point, we're not seeing broad-based demand in the economy. It's still a split two-tiered freight economy that we're seeing, certainly on the spot market side of things where, consumer confidence, retail spending is soft. Imports are not really delivering any broad-based freight lift, although that we are seeing some sort of front loading and peak season now and into July. Demand is still fragmented rather than economy wide, but I think anything tied to industrial freight related to data centers continues to dominate the freight landscape. That AI data center and power build out is one of the biggest freight supports in the market, for steel, concrete modules, transformers, racks, any sort of open deck freight related to that is doing exceptionally well. And part of the reason we're seeing record high spot rates that have just bumped over $3 this week, which is a record high.
Yeah.
But the broader macroeconomic outlook, we talked about this off air, was sort of the what's the outlook look like for the rest of the year? And I think interest rates remain the swing factor because the macro backdrop is really uneven. Residential construction remains constrained. We've got elevated borrowing cost on the consumer side, single family housing starts, things like completions and those units under construction are all down. So I think if interest rates stay higher for longer, we'll move higher again, which is a possibility. Housing linked freight will remain under pressure. So when you look at the different parts of what drives our economy, even last week's ISM PMI was another positive read
Yeah.
for, so we're not, things aren't disastrous, but we're not seeing this broad-based demand that you would normally see, which sort of begs the question, why are spot rates at these record levels? As our TVI report kind of alluded to, truckload rates have climbed faster than freight volumes last month. And that's got a lot to do with the fact that we've had so much capacity leave the market. And Jeff, I think this is sort of extraordinary that you and I are talking here at the start of July after seeing one of the biggest jumps in produce season rates that we've seen in a
Hmm.
decade.
Hmm.
But I could say the same for dry van and flatbed. Like May was a month of records for the spot market. And that's kind of extraordinary when you say, well, if that's the case, then what's driving it? Well, it's not demand, because all of the leading indicators point to fairly choppy demand and maybe flat to up slightly year over year. And it's just this sort of the market has lost its elasticity because there's so much capacity that's left. And I think the important point here, and I'll sort of pause there because I think it's worth some deeper dives. I think a
Yeah.
lot of the extra capacity that we had that was a feature of the market in the last few years, my belief is it's largely exited and that we're at the tail end of this. So, I
Okay.
think Road Check Week really started in January with the 26 state safety blitz. So we've essentially had Road Check Week year. And I think road check week in May really was just the tail end of, cleaning out a lot of these carriers that shouldn't be here. There's still some out there, no question. But I think the idea that there's more capacity to go, that would make a difference in spot prices, in sort of a spike. I don't think that's down the road. I think what we're seeing is we're heading into the dog days of summer where consumer spending changes from, goods to services because they're on
Yeah.
vacation. And that just means that if my theory's right, that a lot of the capacity has exited the market that shouldn't be here for whatever reason, that if you have, we're heading into a summer where rates should start to flatten out, and a lot of that pressure in the market should start to ease and the market lose some of its steam. So that's sort of, I think, where we're at. We've had a phenomenal 6 months, one of the best 6 months carriers have ever seen. Brokers are coming off some pretty low margins because they've been trying to buy capacity at higher rates than they had bids in place from last year. But their
Yeah.
margins are slowly improving. Carriers are seeing record high profit margins, record high, record to the relative to the last decade. And that's sort of where we are. I think we've got uneven demand, a lot of uncertainty in that macro economy that maybe keeps a lid on things throughout the rest of the year.
Okay, great, great. Well put. And I know you already said this, but I just want to reiterate it because it's the lead in your July edition of your truckload volume index, or more commonly known in the industry as the TVI. You guys have simply stated truckload rates climbed faster than freight volumes last month, a disparity that points back to tighter truck capacity rather than strong freight demand, which you just very clearly hit on. But
Yep.
Dean, for those that maybe are not familiar with the TVI, can you just tell us a little bit about the report in terms of sort of its objectives and the data that you're trying to get out there to the market?
Yeah, we've got an index. I mean, lots of analysts or companies have got indexes, and our index measures the monthly change in loads moved with a pickup date during that month. But importantly, Jeff, for loads over 250 miles in the US and Canada. So what we do is we measure the rate of change relative to the baseline of 100 on our index way back to January 2015. And then we use our rate view and IQ analytics platform to, sort of derive which direction the market's heading. So it's an indicator. It's one of, many indicators in the market, but it's a really
Hmm.
solid indicator of what's happening in the spot market because DAT's size in the market kind of represents about a third of, the truckload volume in the spot market. So when you look at it, it gives you, I don't focus on the, nominal values so much, the TVI's actual number. I think with indexes, it's important to look at what direction they're heading and what was the rate of change over time. And, May volumes were up 11%. Up from May, reefer was up 5, flatbed up 12. Again, all point to what we would normally say is seasonality in that particular market. So again, it's an indicator that we saw some seasonality in spring that flowed over into May and will continue into
Hmm.
June's TVI. But I think the flip side of that is the rates climbed way faster than freight volumes, and that was we we telegraphed this. This wasn't a hard prediction back in January. My headline for the 2027 year was stabilizing demand meets constrained supply. And whenever that happens at the bottom of this market where we get to equilibrium, any shock in the market sends rates skyrocketing and then they come back down. We saw it during road check week. We saw it during Mother's Day, Valentine's Day, even back to Super Bowl when produce volumes soared in that week before Super Bowl. So when you get to sort of this equilibrium part of the market where roughly loads equals trucks in a fairly simplistic manner, anytime you get a surge in volume and the capacity has sort of lost its elasticity and is largely exited the market before we start adding capacity back in, you see these surges in spot rates, which is what we saw. Road check week, Jeff, was record high week over week increases in spot rates. And the crazy thing is, the market has held on to those gains from road check week right through to July 4, which is extraordinary. But it really points to how much capacity has exited and how tight the market is from a spot market capacity perspective.
Oh, no doubt about it. And I mean, the headline kind of says it all for this edition. And obviously, we're talking about June here, but in June, the van spot rate topped the contract rate for the first
Yeah,
time going back to February 22, with flatbed also setting a record. So,
yeah.
not an inconsequential month.
No.
A lot happening there, and you didn't have the noise, if you will, from road check, for example, that was more prevalent in the prior edition.
Yeah.
Um, so I mean, there's a lot going on there, to say the least. One thing that, and we talked about federal government actions in terms of CDL remove, non-domicile CDL, English language proficiency, and other actions on that front. It's really been a year like no other, it seems, when it comes to these
Yeah.
types of efforts.
Yep.
So I think that'd be something interesting for our audience to get your take on, Dean. It's just simply what's been happening on that front.
Yeah, this all started back in March last year, of course, when a driver was, allegedly pulled out of a truck and arrested and fined $5,000 because he couldn't speak English. That was really the tip of the iceberg. And as it turned out, within a few months, we had executive orders and all sorts of regulations in place. And fast forward 15 months, we've now got new regulations in place. We've got Delilah's Law currently waiting for a
Yep.
vote in the House, I think. But I think what's more interesting, Jeff, is that we've got some states like Alabama developing their own state-based regulations around English language proficiency.
Okay.
And aside from the feds, so you think about running, 48 states. Well, now carriers have got to think about what states do I avoid if I'm, in this cohort that has a problem with the English language. And then, of course, we're waiting for the federal laws to come in. But I think the without the laws, I think the psychology has changed the way drivers approach this market. They've either left the market completely, or they've modified their driving tactics. And, like the southern border is a great example. So is Florida. But the southern border, if you remember, southern border had ICE and DHS set up camp back in September last year. And of course, the southern border in the Rio Grande Valley down near McAllen is where about half of Mexico produce comes across into the US.
Hmm. Hmm.
So, and because minority truckers are disproportionately represented in the long haul team produce space, we kind of anticipated that we see a capacity crunch along that southern border. And that's pretty much exactly what's happened since September last year, where rates on those lanes out of McAllen back to California, from whence the capacity comes from in the first place, was very, very tight because the drivers simply said, I'm not going to go anywhere near the southern border where I might be subject to any form of harassment. Whether they're legal citizens or not, because it becomes a big time factor if you start to get tied up in that state stuff. But of course, there were drivers that were, arrested. We saw the same in Florida in early April with one of the big blitzes they had. They had a 4-day blitz. I think there was something like 8,000 trucks inspected. There were quite a few drivers. I think they were in the sort of 50-ish range that failed the English language proficiency. There were some people that were taken off to jail. There was some real wild things found in that blitz. But if you think about that all goes back to January this year when the government started their 26 state blitz, and that's what's been going on this year in earnest. Is this focus on chameleon carriers, the ghost fleets, the drivers that can't speak English, that can't read road signs, and then of course you've got the whole focus on ELDs and the jailbroke ELDs was sort of one word I heard talking about it, but essentially it's these overseas organisations that are resetting drivers' hours of service every morning, allowing them to run incredible miles but report far fewer miles on their when the logs are downloaded. So you've had all this extra capacity on the illegal ELD side, and then you've got the
Yeah.
FMCSA trying to clamp down on the ELD vendors that aren't compliant. So you've had it, and then of course they've changed. Driving schools are now are required to only do driver training in English. So it's like this multifaceted approach, and it's what I call the great recredentialing, because the entire industry is being recredentialed, both drivers, training companies, the FMCSA level. there's a level of focus on the industry that I've not seen ever in the 25 years I've been here. And how it's played out is there's just all of this excess capacity that joined during the pandemic is large. We're at the tail end of this right now.
Yes.
And that's what we're still trying to work through. But I think Shelley Simpson at JB Hunt said it in her earnings call late last year that the market, she said, it appears to have lost its elasticity. Well, fast forward, 9 months, it absolutely has lost its elasticity because you're not seeing the amount of available capacity that can absorb these massive flexes in volume that come around, big industry events like, July 4. July 4 was normally is what we call produce season in the rate world, Jeff. But we just saw if I went back to 2016 and said, what's the average increase in refrigerated spot rates, just to see how tight the market was. Well, so remember the backdrop here is that year to date produce volumes are down about 12%. So we've got less
Yeah.
produce volume in the market. And the average rate that changed from, Vidalia onion pack date mid-April to July 4, which is the bookend for produce season, mid-April to July 4, reefer rates average about a plus 23% gain over that time frame. This year, double, 50 cents per mile, reefer
Wow.
rates jumped. So you say, well, okay, hang on. Produce volumes are down on last year. And last year wasn't a great year, and we're on par with the last 15 years in terms of produce season. But volumes aren't doing anything spectacular. They're lower year to date. Well, how come reefer rates jump double the normal average? Well, it's simply because a lot of our produce comes from California, and California's been right in the sights of the federal government when it comes to drivers that are minority drivers, drivers that shouldn't be in the industry. All that immigration status, non-domicile CDL has really been focused on California. And because it's a big produce state, a lot of your long haul produce truckers are minority truckers. And so what you see is this, even though volumes are down out of California, the rates are holding 40 to 45% higher than a year ago on all those long haul produce lanes. So another great example of how bizarre this year is, where demand isn't doing anything exceptional. It's all supply that's doing the heavy lifting around these record high spot rates we're seeing.
No, no doubt about it. And I know we've had similar conversations on this front in the past, but at least to me, it doesn't make it any less remarkable. Just what we've seen without that true demand-driven catalyst, Dean, that we've talked about many times in the past.
I think yeah, I think it's extraordinary that we've seen this much gain, but I think it begs the question: how much more runway does the market have?
Hmm.
But
Hmm.
beyond that, because I think markets rates will cool as we before we get into the fall holiday season. But Jeff, imagine if demand is broad-based and the economy takes off and interest rates drop. Like you look at any form of improvement in any of these big sectors that we rely on for tonnage. Can you imagine what this market looks like? Because that door that drivers come through, both for large carriers and the spot market, has just got exceptionally narrow.
Yes.
It's going to be
Yeah.
hard to find drivers and keep drivers. You're already seeing record high pay rates offered to drivers right now from large carriers. Sign-on bonuses are back in vogue. And, ACT Research's driver supply index has been negative for 4 months. So we're seeing supply contract fairly aggressively. So it just points to, if you look down the road and say, okay, demand improves 2027, let's fast forward to there, and driver supply is relatively tight. Who drives all of these trucks? Because
Yeah.
the recredentialing means that it's going to be harder to get into the industry. So you would say, okay, well, driver pay must be a bigger component. Well, driver pay is about a third of your costs. That means that if you add in the tariffs and the impact on steel and aluminum, we are about to see a step change in what it costs to run a truck in the market, which goes to the shippers side of it. We're looking now at coming out of a period of multiple years of having pricing power to a very tight contract and spot market going well into 2027, where and I don't think it's linear, Jeff. I think it's a step change in what it costs to
Mhm.
run a truck. and being the owner of a truck, I can assure you that this isn't linear. We're about to see a step change in the operating costs of assets, which
Yeah.
is
Yeah.
which is something I think shippers need to be acutely aware of because that's not cyclical. That's a step change in costs because of tariffs and regulations.
No, no, for sure. And that got me thinking, Dean, from the perspective of the shipper, looking at this from the other side, do you think now, under that premise that you just laid out, with demand coming back in a more meaningful way, do you think that would lead to a situation for shippers in which they really have to take really a different look at perhaps
Mm.
leveraging dedicated
Yes.
operations,
Mm.
private fleet? Now, I know that depends on the size and how well capitalized a certain shipper is, and obviously the vertical that they are in. But are you seeing or hearing any signs or indications of that, or is it just simply too early? Because again,
Yeah.
that demand
Yeah.
driver may not be there.
Yeah, too early based on our shipper consortium, too early to tell if they're looking at because they're still trying to absorb carriers rebidding last year's contracts and still trying to figure out how high are rates going to go because you look at dry van replacement rates are coming in about 8.5%, close to 9% higher than they were a year ago. So there's been a repricing of contracts from last year, which were, of course, at fairly suppressed levels. So that sort of points to that prediction we made last year that a lot of contracts that were in place weren't serviceable at the rates they were at. And of course, here we are now with contract rates going up, almost 9%, reefer rates going up 7, flatbed replacement rates are coming in about 13% higher than they were a year ago. So shippers are still trying to grapple with the speed at which the market has turned, and then they're trying to figure out, well, how bad does bad get? And I think that's the point I've been saying to shippers is this isn't cyclical because the supply reduction is structural and permanent. Like these drivers that are leaving aren't coming back. They're certainly not coming back in a hurry unless they meet all of the standards. So that means that supply is going to be very tight for shippers. And I think that means that they're going to have to be very, very diligent in working with their incumbent carriers to lock in that capacity at rates that are, fair rates. I think a lot of carriers are looking to get rate increases,
Hmm.
largely because they've been operating at rates that I don't think were sustainable for the last 2 to 3 years. And I think that's been fairly well documented because we've seen, in our dry van spot market, they were losing money for 25 of the last 31 months. This was an extended period of time since late 2022 or mid 2022 to just before Christmas last year, where carriers were really underwater and struggling to get by and make decent margins if any margins at all. But the last 6 months though have been a real catch up for them. They're still, if you said, well, where are carriers right now? I would say to you that dry van profitability is about 50% of what it was during the pandemic, which of course was
Hmm.
money was falling from the sky back then. But
Yeah.
they still haven't recovered that,
Hmm.
but this massive swing in profitability because spot rates are up has changed a lot of the view of the freight market. And I think what we get to pretty quickly is a new cohort of capacity coming back into the market. And it's different capacity, of course, because it has to meet newer and higher standards.
Yeah, yeah, 100%. Dean, one thing that we haven't talked about, but it definitely has a huge trucking element or angle, is the recent Montgomery Supreme Court ruling, which essentially the court essentially ruled that negligent hiring claims against freight brokers fall within the FAA's, which is the Federal Aviation Administration
Yeah.
Authorization Act, my bad, within the F4A safety exception, which preserves state authority over motor vehicle safety. But because such claims require brokers to use reasonable care when selecting carriers, they do relate to the safety of trucks operating on public roads. This got a huge amount of attention, obviously. We talked about it a lot. And I know that, again, this is one of those topics that we could talk about for a long time. But what was your take on the Montgomery ruling, and perhaps what it
Yep.
means going forward. I know you told me initially when I taught that this makes compliance even more of a competitive advantage than ever, or something
Yeah.
to that effect.
Yeah. Yeah. I think it becomes less of a line item on a P&L and actually becomes your competitive advantage. Of course, for a lot of the big brokers and carriers, they were already doing a lot of this heavy duty vetting anyway and had good systems in place. But I think what it does, it shines a light on all of the other brokers and carriers that didn't have good compliance methodology in place. I'm not saying they were unsafe or doing something wrong. It's just that they didn't have a level of compliance that you could argue in a court of law that you actually met the standards. So I think you end up with this sort of chasm, Jeff, between the have and the have-nots, and it means that for a
Hmm.
lot of carriers in the spot market, and this gets to the questionable nature of using the federal motor carrier data anyway. Like you sort of think, okay, I've got a carrier here that has been a owner operator or a company driver for 10 years and goes out and gets his own authority. Well, he probably can't get a load for 6 months because he's got a new authority, yet he's got 10 years of experience. So there's a very lot of subjectivity around that. But then, of course, you get to these systems that say, well, if you haven't got an inspection or you've got an ELD violation, we're going to can you. We're not going to load you. And of course, that's a fairly subjective thing to do, in my opinion, because I don't think any of that's got anything to do with safety on the road. Like in terms of accident probability, nothing
Hmm.
changed with Montgomery. You can still be 100% compliant with your hours of service and have no violations, yet be sound asleep at the wheel at the same time. So, in terms of the probability of nuclear verdicts that Montgomery is going to obviously encircle, that hasn't changed. The probability of accidents hasn't changed. Of course, what's changed is the level of exposure that the broker network now has from using those carriers. So it's almost like I don't think anything has changed on the road other than there'll be a lot more focus on the entire supply chain now. And I think that we'll see it apply to shippers, because questions will be asked. How did you vet that carrier? How long did that carrier stay on your loading dock? What amenities were provided? What was the screening that you used to, pick that carrier or that broker? Like, I think there's just
Hmm.
going to be
Hmm.
the courts are really going to open up a whole Pandora's box here. And it's going to be a big problem, I think, for any carrier or broker that doesn't have stellar systems in place that, meet the standard. Now, the standard is whatever, the government sort of says is the standard for, carrier safety.
Yes.
I would say you've got to go even more than that to vet carriers because the idea that you can look at someone's inspection history and determine if they're a safe or compliant carrier is kind of ludicrous from my perspective as someone who owns a truck and still drives. Like, it just, none of it makes any sense. But I understand where we're heading, and I think this is sort of, this is a really interesting data point, I think, for the carriers that don't have good systems, because I think they'll find it very hard to get spot market freight if they're not meeting they're not checking all the boxes, whether the
Yeah.
boxes are right or wrong. If they can't check the boxes, I think what you end up with is a smaller group of carriers that check all the boxes in the spot market, and capacity just becomes even tighter,
Hmm.
which puts
Hmm.
more upward pressure on rates.
Yeah, no doubt about it. So, Dean, we're getting near the end here of our allotted time. So why don't we we'll do two more quick ones here. One I'll kind of bunch together because it's trade related. As most people are aware of, late last week, the United States announced it is not going to renew its participation in the United States Mexico Canada Agreement, also known as USMSA, formerly known as NAFTA. Now, this one, I mean, this is the deal still has 10 years left.
Yeah.
But what was your initial take on that, Dean? In terms of what it means for freight movements, from a cross-border perspective, in terms of with the North American element, US, Canada, Mexico. And then the other part too of the tariff and trade round of questioning today will simply be the Section 122 to 10% Section 122 tariffs are expiring later this month. Office of the Trade Representative in the White House have been very busy with the Section 301 tariff reviews. which we can probably expect to be rolled out in the form of brand new tariffs sooner than later. Both things that obviously over the road stakeholders are paying close attention to. How do you view those developments?
Yeah, I think the fact that we're seeing a peak in imports coming in from Asia right now tells you how shippers are looking at this. We're seeing peak season happen early because I think
Yep.
there's a general fear that even if the 10% tariffs expire, there's something else coming. I think that people are anticipating that. So this is part of the reason we're seeing such a surge in imports, probably 2 to 3 months earlier than what we would normally expect to see, which is in that August timeframe. So I think that's sort of the broader picture on where tariffs sit, is this uncertainty is driving, a lot of shippers into front loading a lot of their imports for the retail
Yeah.
season coming up. On
No,
the
no
on the
doubt.
on the Canada side, I don't see much change other than a lot of that volume that we would normally see cross border has kind of gone away, and that doesn't come back when Canada finds other supply chains that are not the USA. But having said that, volumes have bounced back a little bit on that cross border lanes. We're still seeing reasonable volumes. It's not what it was. It's way lower than what it was,
Yeah.
particularly in the flatbed space. Flatbed's taken an absolute hammering because of the dependency on, those big steel works around Kingston. The big, you got a lot of steel that comes cross border, a lot of coil moves back and forward for the automotive processes on our side of the border. So I think there's a couple of issues because there's the whole issue of non-domicile CDL and English language proficiency also affects the Canadian carriers just as much. And so the whole cross-border market has been impacted by government regulations on both sides of the border, aside from the volumetric data that we look at. So I think there's permanent changes, Jeff. I don't know that a lot of these markets come back because people will have moved on to other, sources of inputs into their supply chains.
Right. Yeah. No doubt about it. And then you kind of answered the question indirectly, but the a lot of the what's happening in light of these tariff developments, in part was certainly a large driver for a lot of earlier than usual shipping, especially as it relates to peak season, which we would more start to see in the starting to develop phase, if you will. But do you think a lot of peak shipping activity, for the fall peak that is, has already occurred or is happening in a meaningful way now?
I think it is. It's happening. We saw May volumes were up 11, almost 12% year over year, up 13% month over month. So,
Hmm.
normally you get into May and volumes are, not increasing, but they certainly surged in May, which told us that there was something coming. I'm a couple of days away from having a look at the June data. That'll tell us. But then I think the forecasts are for volumes to fall off and be pretty weak by the time we get to the end of the year. So again, we're seeing this big pull forward, which impacts the entire market because this is sort of creates this again a pull forward, bubble. It creates this sort of air pocket that people talk about on the back end of the
Yeah.
year when you normally see freight volumes. So again, here we are, 2026 going into 2027 with more uncertainty in the market and more questions about what the current administration is going to do on the trade front. But we are seeing, shifts that you wouldn't normally see in the freight market. In terms of where volumes are headed. That there's some ports are doing exceptionally well, others not so well because trade is shifting. You look at Houston, for example. Houston volumes were up 24% year over year in May, the highest
Yeah.
we've seen since 2016. And because you've got a lot more infrastructure built around that Dallas Fort Worth area now with a big intermodal hub that's sort of serving as a major import distribution hub in that southwest part of the country. And Houston's a wonderful port for people to get in and out of. So, like you look at the big ticket items, furniture is up 44% last month. It's up 31% year over year. Furniture is by far our biggest import item in containers, like by a long shot. And when you see it's up 31% year over year, it kind of points to this massive front loading that we're seeing, across the country.
Yeah, no, that it's really interesting to see how it's evolved over this period. Well, look, Dean, this brings us to the end of our allotted time for today's podcast. So, on
Thank you.
behalf of Logistics Management Magazine and the Peerless Media Supply Chain, I'd like to say thanks for joining us.
Thank you. Love being on with you, Jeff. Thank you.
Yeah,
Appreciate it.
absolutely. It's been terrific. And for those listening in that would like to connect with Dean on LinkedIn or just to simply check out his posts, which are all really good, just simply go to linkedin.com/IN uh, backslash again, then Dean Croke, all one word, DEANCROKE backslash. And also, please give us a follow on Twitter, simply at LogisticsMGMT. And also, please, by all means, go ahead and sign up for our podcast wherever you get them. And just punch in the Logistics Management Podcast, and it'll come right up. Thank you, everybody. Have a great day, and we'll talk to you real soon.